Let's break it down. For years, China had a simple playbook. If growth slowed, you poured money into construction, factories, and big projects, and the economy sped up again. Now that engine itself is stalling. Investment is slowing, some projects are being delayed or cancelled, and the weakness is showing up across the country. I'm Imran, a Middle East-based analyst who follows global economics and politics. In about 3 minutes, let's walk through what's happening inside China's investment machine and why it matters. If you like clear, simple breakdowns like this, please hit subscribe so you don't miss the next one. First, what is actually going wrong with investment? China's leaders just wrapped up a key economic meeting in Beijing, and this time they openly admitted that investment is weakening. Fixed asset investment, money going into buildings, infrastructure, factories and equipment, has started to slow and, in some areas, even fall compared with last year. The biggest drag is the property sector. Developers are loaded with debt, home sales are weak, and new housing projects are being shelved. Local governments, which used to raise easy cash by selling land to those developers, now have less money and less appetite for huge new projects. So the old growth model of build more apartments, more roads, more industrial parks is no longer giving the same boost it once did. Second, why is this investment collapse happening now? There are 3 big reasons. Number 1, debt and the property bust. After years of heavy borrowing, developers, local governments, and state firms simply can't keep piling on new loans. Banks are more cautious and some projects are being frozen mid-construction. That hits jobs and confidence. Number 2, policy uncertainty. In recent years, Beijing has cracked down on big tech platforms, private tutoring, and other industries. The message is that growth must be high quality, not just fast. But for many private companies, this feels like a warning not to expand too aggressively. When you're unsure about the rules, you invest less. Number 3, weak confidence at home and abroad. China is facing an aging population, deflation risks, and ongoing trade tensions, especially with the United States. Exports are still large, but global demand is uncertain. When companies are not confident about future sales, they delay big capital spending. Quick pause here. If this kind of breakdown helps you see beyond the headlines, please like the video and make sure you're subscribed. It really helps the channel grow and tells me to keep making more videos like this. Third, what is Beijing doing about it, and what are the limits? Chinese leaders say they will keep a proactive fiscal policy, more government spending, tax breaks, and targeted support for both investment and consumption. They want to revive the property market, fund infrastructure, and push more money into high-tech areas like chips, green energy, and advanced manufacturing. You can see this in showcase projects such as new planned cities and industrial zones built around state-owned giants. Billions of dollars are going into roads, offices, and high-tech parks. This is classic state-led investment. When the private sector slows, the state steps in, but there's a tension. Beijing keeps saying it wants more household spending and a more balanced economy, yet it still falls back on top-down investment to hit growth targets. With so much debt already in the system, each new wave of projects raises the same question: who will ultimately pay for it, and will the return be worth it? So let's break it down one last time. China's economic pain is now visible in the place it used to look strongest: investment. Property developers are struggling, local governments are stretched, private firms are cautious, and even big state projects can't fully hide the slowdown. Leaders are promising more support and more high-tech spending, but they are still struggling to move away from the old model of build more and growth will follow. For the rest of the world, a weaker and more cautious China could mean less demand for raw materials, more dependence on exports, and a more defensive economic posture. This is Imran Breaks It Down. If you found this helpful, please subscribe, like the video, and tell me your thoughts in the comments. Do you think China can really shift from property and construction to a more balanced high-tech economy, or is it stuck in its old habits? Share this with a friend who follows China's economy. And if you're already subscribed, thank you. We'll keep breaking it down together.